The Bank of Canada has been raising its key interest rate steadily since 2021 in response to the strong economic recovery from the pandemic. The latest increase, announced in May 2023, brought the rate to 2.5%, the highest level since. This means that Canadians who have loans, mortgages, credit cards, or other forms of debt will have to pay more interest on their borrowings. It also means that businesses will face higher costs of financing their operations and investments. But why is the bank doing this? And what are the implications for the economy and the inflation outlook? The main reason for the rate hikes is to keep inflation under control. Inflation is the general rise in the prices of goods and services over time. The bank has a target of keeping inflation around 2% per year, which it considers to be consistent with a healthy and stable economy. However, inflation has been running above this target for several months, reaching 3.4% in April 2023, the highest rate since. This is partly due to temporary factors, such as higher energy prices and supply chain disruptions caused by the pandemic. But it also reflects stronger demand from consumers and businesses, who have been spending more as the economy reopened and restrictions eased. The bank believes that by raising its interest rate, it can slow down the pace of economic activity and reduce the pressure on prices. Higher interest rates make borrowing more expensive, which discourages spending and encourages saving. This reduces the demand for goods and services, which in turn lowers their prices or prevents them from rising too fast. The bank hopes that by doing this, it can bring inflation back to its target range of 1% to 3% over time. However, raising interest rates also has some risks and trade-offs. For one thing, it can hurt economic growth and employment, especially in sectors that are sensitive to interest rates, such as housing and construction. Higher interest rates can also dampen consumer confidence and business sentiment, which can affect future spending and investment decisions. Moreover, higher interest rates can cause the Canadian dollar to appreciate against other currencies, which makes Canadian exports more expensive and less competitive in foreign markets. This can hurt export-oriented industries, such as manufacturing and tourism. The bank has to balance these costs and benefits when deciding how much and how fast to raise its interest rate. It has to consider not only the current state of the economy and inflation, but also the expected future developments and uncertainties. The bank has indicated that it will continue to monitor the economic data closely and adjust its policy as needed to achieve its inflation objective. The bank has also stressed that its interest rate decisions are not predetermined or mechanical, but depend on the evolving economic situation and outlook. The Bank of Canada has been raising its key interest rate since 2022 to cool down the economy and bring inflation back to its target of 2%. Inflation reached a 40-year high of 4.9% in 2022, but has since declined to 4.4% in April. The bank's last rate hike was in March 2023, when it increased the rate to 4.5%, the highest level since. However, the bank also said that it would pause its rate hike cycle and wait for more data to confirm that the economy was slowing down enough and that inflation was falling further. The bank said that its pause was conditional on whether the economy developed as it expected and whether inflation continued to fall. Since then, the economic data has been mixed. On one hand, the economy grew faster than expected in the first quarter of 2023, expanding by 3.1% annualized, compared to the bank's forecast of 2.5%. On the other hand, some indicators suggest that the economy is losing momentum in the second quarter, as consumer spending, business investment, and exports have moderated. The bank also faces uncertainty about the impact of the global pandemic, trade tensions, and environmental issues on the economic outlook. The bank has to balance these conflicting signals and decide whether another rate hike is needed to prevent inflation from rising again, or whether a pause is warranted to avoid choking off growth. The bank has to weigh the risks of acting too soon or too late, and communicate its reasoning clearly to the public and the markets. Some economists and investors think that the bank will raise its rate again on Wednesday, June 7th, citing the strong GDP growth in the first quarter and the persistent inflation pressures. They argue that the bank cannot afford to fall behind the curve and let inflation expectations rise. They also point out that the bank has a history of surprising markets with rate hikes when they least expect them. Other economists and investors think that the bank will keep its rate on hold for now, citing the signs of moderation in the second quarter and the uncertainty about the global environment. They argue that the bank should wait for more evidence that inflation is falling sustainably, and that growth is slowing enough to warrant a pause. They also point out that the bank has a history of being cautious and data-dependent in its rate decisions.